Today, I want to talk about how an order imbalance in AMC has thrown the shorts into chaos. I want to explain how this could possibly be the final straw that breaks the camel's back, and explain how the shorts are losing or have fully lost control. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, David Murphy has tweeted this screenshot from Reuters, which shows multiple imbalances in both AMC and APE. Reuters are reporting a New York Stock Exchange order imbalance in AMC of 156,000 shares on the buy side. And they're also reporting a similar order imbalance in APE of 249,000 shares, again on the buy side. He's also posted the screenshot from Investopedia explaining what an order imbalance actually is. So it says an order imbalance is a situation resulting from an excess of buy or sell orders for a specific security on a trading exchange, making it impossible to match the orders of buyers and sellers. Basically, there's too many buy orders being placed for AMC that cannot be satisfied because there's not even enough shares of AMC to buy on the New York Stock Exchange. AK, we still have a massive abundance of buyers, but zero sellers and zero available shares. It says for securities that are overseen by a market maker or specialist, shares may be brought in from a special reserve to add liquidity, temporarily clearing out excess orders from the inventory so that the trading in the security can resume at an orderly level. Now this is actually quite interesting because without that special reserve, trading would be happening not at an orderly level, but at a disorderly level. And it says extreme cases of order imbalance may even cause suspension of trading until the imbalance is resolved. The key takeaways say that order imbalances exist when there's an excess of buy orders or of sell orders. Most order imbalances are short-lived, but can exist for hours and even the entire day. Now obviously people in the comments are speculating, saying how can there be so many buyers but zero sellers? Unless of course synthetics have been sold in the past and this is going to create additional synthetics or future FTDs. Jeff pointed out, saying if only there was an organisation that should be policing and enforcing rules in the securities market. But unfortunately, I can't think of any that actually does the right job. I think actually in the last 2 years, this is the first ever time we've seen actual order imbalances being reported for AMC. We've always seen an abundance of shares available to borrow, but I think this is the first ever time there have been zero shares available to buy on any stock exchange. The market makers have quite literally run out of AMC shares that can possibly be bought. And I think definitely the theme for this video is how things are occurring now that have never occurred before in the last 2 years. As a prime example, if we look at every single company in the entire stock market, and not just in the US stock market, but also including the Israeli stock market, Australian market, Chinese market, British market, and every other market in the world, AMC has the highest cost to borrow rate in any stock in the entire world. Not only is this the first time AMC has held that #1 position, but it's also the first time AMC is setting a new all-time high borrowing fee over 1,000%. AMC for Life is saying that we are finally watching the hedgies lose their grip. Also, you can currently get a guaranteed free share of Tesla and a cash reward, which you could always use to buy more shares of AMC, APE or of GameStop. All you have to do is sign up to Moomoo using the link in the description below and make the required qualifying deposit. Signing up to Moomoo is free, it just requires a temporary deposit, and it's a really great way to support me and to support the channel. Moomoo is also really easy to use, they've got tons of technical indicators and they even have their own inbuilt options trading platform. Now I personally don't know why the shorts are losing control of the cost to borrow fee. I don't know why the shorts are losing control over FTDs. I don't know why the shorts are losing control over order imbalances. These are all things the shorts have had very much under their control over the last 2 years. For the majority of the last 2 years, we've only seen a cost to borrow fee of 1 or 2%. For the majority of the last 2 years, we've only seen FTDs at say 50,000 or 100,000 FTDs per day. And for the last 2 years, we've seen hundreds of thousands, if not millions of shares available to borrow and available for sale on AMC every single day. So I don't know why the shorts have all of a sudden lost control at over 1,000% cost to borrow fee pretty much every single day over the last few months. I also don't know why the shorts can no longer keep control over those FTDs, as we're basically bouncing from day after day on that regulation SHO list. We spent over 20 days on that SHO list the other month, and we're now already back to the 19th day on the SHO list. And I also don't know why the shorts are having to open up lawsuit after lawsuit after lawsuit to try and delay AMC. And it seems the market makers and the shorts can't even sell shares of AMC to willing buyers like you and I. Clearly something has broken for these hedge funds, as they no longer have a grip on the market. They don't have a grip on cost to borrow, they don't have a grip on FTDs, and they don't even have a grip on shares available for sale. And that's why AMC for Life says when AMC starts running, it's going to be explosive and make the $72 sneeze look like nothing. You have to remember, on that run to $72, we only saw a few million FTDs. We only saw about a 20% cost to borrow fee. We didn't see 100% utilisation, and we didn't see any order imbalances. AMC for Life added saying it's 2.5 years later, but his resolve is stronger than ever. Something is clearly broken in the market for these shorts and for these market makers. I personally don't know specifically what's broken, but it's clear as day to see something is going wrong. I think this photo might put into perspective what's been happening over the last 2 years. Stain and Steel posted saying this is the can they've been kicking down the road over the last 2 years. You'll notice something quite interesting about this can, and that is there's not much left of this can to kick. Every single time they've kicked the can over the last 2 years, something has been going progressively more and more wrong. Whether it's because they've been paying fines on their FTDs, whether it's because they lose money when they roll their call and put options, or whether the losses have just been mounting. But something has been getting progressively worse day after day after day for the shorts. And now there's not much left of the once can that they kicked to kick anymore. Charles Payne has also tweeted saying movie going dead, you just need movies people want to see. So stop with the political agenda and get back to the art of storytelling. And that's because Barbie has just had the best ticket pre-sale since Avatar: Way of Water. Again, Charles is asking the shorts to stop with their political agenda to try and bankrupt AMC and just to let AMC prosper and for people to go to the movies. You'll also remember Charles Payne tweeted about Carvana yesterday, and Investor Turf has added, saying Carvana short sellers have lost more than $2 billion this year, as the online car retailer stock has rallied more than 1,077% year to date. I wonder if this is what's going wrong with those short sellers. They're taking losses left, right and centre on Carvana, on Coinbase, on Affirm, on Upstart, on Tesla, on Nvidia, on Microsoft, Google, and pretty much every other stock in the market. These shorts are being squeezed to death and they're desperately trying to bail out of their short positions, trying to protect whatever capital they have left in their hedge fund. As a prime example of protecting whatever capital they have left in their hedge fund, check out this tweet from McSqueezy the Cow. He tweeted saying, did you know that Highbridge Capital, the hedge fund arm of Jamie Dimon's JP Morgan, has $7 billion in assets under management? However, their current AUM is 78% lower than the fund's all-time high of $31 billion back in 2016. And it's also 54% lower than what the fund first started with back in 2005. Highbridge Capital, like many other hedge funds, has been losing more and more and more money over the last few years. We've seen funds like Tiger Global and Melvin Capital down well over 50%, and many other hedge funds closing their doors since then. But while these shorts try and desperately hang on to whatever they've got left, they're getting punished more and more and more. Not just in big tech stocks, but in smaller growth stocks and in meme stocks as well. And that's why, interestingly, David Marlin has tweeted saying with the year-to-date rally, the S&P 500 has decoupled from the global liquidity proxy from the first time since pre-2020. Right now we're seeing the market being inflated for these hedge funds to try and desperately hang on to whatever they have left. But in reality, the market should have been crashing even further. The market should really be tracking this blue line, which is the global liquidity, and realistically setting new market lows. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.